took over as lead manager of Strategic Equity Capital 6 months ago, the end of September. And at the time I signalled that there weren't going to be any dramatic changes to the portfolio or the strategy of the trust, but that over time we would gradually evolve it to incrementally reduce the average market capitalisation of the companies within the portfolio and increase the average equity stakes within the portfolio to support our strategy of constructive active engagement. And really that's what's happened over the last 6 months. We haven't made dramatic changes, although portfolio turnover, I'd say, has been elevated relative to history. But that's more of a function of the market conditions rather than sort of major changes to our approach. We've made 4 new investments into the trust over the last 6 months, and we've made 5 full exits. And so the portfolio currently stands at 20 stocks, which has typically been around the level that it's tended to have. And the majority of the value still sits within the top 10 holdings, as it has done historically. So in terms of the current positioning, there's no major changes there. We focus on high quality stocks with attractive financial characteristics, typically in structurally growing areas or niche markets where we think we've got a tailwind or protection to those companies' positions. And that hasn't really changed. We try to avoid overly cyclical areas, so we don't invest in sectors like mining and oil and gas. And that may give us a sort of relative performance headwind at certain points in the cycle. But over the long term, we think that provides not just an opportunity for attractive returns, but also more consistency and lower volatility than the overall market.
So the trust delivered really pleasing absolute performance over Q1 with the net asset value up 12.4%. And this built on a really strong trend of performance since November last year, when the approval of vaccines and the associated improvement and optimism around the macroeconomic environment drove a really strong bounce in the market, including the UK small cap market. The trust has lagged over this period relative to the market, and that's mainly because the market has been driven by highly cyclical sectors, which we, by design and as a feature of the strategy, don't look to invest in. This includes the resource sector, the oil and gas sector, and financials like banks and insurers. So the key drivers of performance, I think there's 3 themes that apply both to the trust and also to the market as a whole. The first is increasing certainty and visibility of earnings over 2021 and beyond, driven by increasing visibility of economies unlocking as the vaccine rollout progresses. So we've seen that in our portfolio, but also across the market. Secondly, M&A, both inbound and outbound, has been a feature, and Q1 has been a very busy period for M&A and IPOs, and our portfolio is no exception to that. We've seen M&A as a feature both outbound, so our businesses in the portfolio acquiring other businesses, and also inbound. And there's 2 companies in the portfolio which are currently under offer from private equity buyers, that being Equinity and Proactus. In terms of outbound M&A, I think it's a reflection of the increasing confidence that management teams have around the strength of their balance sheets and also the earnings progression as we go through the year. And the third factor, I think, is increasing market optimism, which has driven really strong share price performance in businesses which had been often at very depressed levels throughout last year. So we have seen some of our holdings benefit from that, although I would say that that's been more of a feature for the more cyclical areas of the market where we have limited exposure. So 2 companies I'd like to draw out, which are really key contributors to performance in the period, were Tribal and Medica, and both of them benefited from those 3 themes which I spoke about. So Tribal Group is an education services and technology provider. Medica is a teleradiology company, which I'll come on to talk about in a little bit. And both benefited from relaxation of lockdowns driving earnings progression. Tribal in particular won a number of large contracts towards the end of last year. And also both have undertaken M&A, which positions them well strategically to execute on their plans for the medium and long term. And I think more broadly, it's really pleasing to see management teams and boards being able to look ahead, think more strategically, and think about how to deliver value over the long term, rather than, I guess, over much of 2020, it was a case of survival, driven by the heightened uncertainty that the COVID pandemic brought.
Over the past 6 months, we've made 4 new investments and 5 full exits from the portfolio. On the sale front, typically what the companies we've sold have been stocks that have been towards the later stages of the original thesis and have performed well, and we thought it was appropriate to take profits and reinvest those proceeds into new opportunities. And I think the market dynamic that we've seen over the last few months with respect to COVID really having very different effects on different industries and different segments. That's really played out in how we've approached this portfolio rebalancing. So we've sold companies like Ergomed, which has been a really, really strong performer. That was a healthcare services business that had really strong performance through the COVID period, and the share price reflected that. We've also sold out of companies like JTC, which is an offshore company and trust administration business, and generated a 40% IRR over the course of our investment. And then lastly, Strix, which is a manufacturer of kettle controls, which again had performed very strongly, delivering almost a 50% IRR over the life of our investment. So these are great companies. We think they still have long-term growth prospects, but we felt there were better opportunities to make better returns on redeploying that capital elsewhere. In terms of new holdings that we've added to over the last 6 months, the key ones have been a company called Fintel, which is a provider of software and services to the IFA community, and increasingly it's a digitally focused platform that also is able to take the data that it collects from the IFA side of its business and productize that and sell it to product providers in the fund management space. The other major new holding we've made is a company called Ten Entertainment Group, which is a 10-pin bowling centre operator. It's the number 2 player in the UK market. And whilst clearly it's had a pretty disrupted trading patterns over the course of the last 12 months due to COVID and lockdowns, we think the business is well capitalised, the management team is strong, and actually its competitive positioning will be enhanced as we return to normality because of greater pressure on the independent part of that sector. So we think there's good long-term growth opportunities for that company, both in terms of investing in its sites and driving return on capital from greater footfall and higher revenue per square foot, but also through expansion into additional sites.
So Medica Group is one of the biggest holdings in the portfolio, and I'd like to bring it to life a little bit. I think it's an excellent company with fantastic long-term prospects. The company provides teleradiology services predominantly to the NHS, and what does that mean? It's where radiologists will interpret a scan, an MRI or a CAT scan from the comfort of their home using technology that Medica provides, rather than reading that scan in the hospital. And that technology allows hospitals and healthcare providers to be much more flexible and cost effective in the way that they deliver those services to patients. Why do we like the business? I think it's in a structurally growing area of the market, and that's something we look for in our investments. The amount of scanning that's happening in the NHS and elsewhere in the healthcare system is increasing day by day and year by year as the population ages, and also as the sophistication and use cases of scanning increases. Secondly, it's a market leader. It's the biggest player in the UK, and it's got a really strong and long-term relationships with its customers. And thirdly, I think this is missed by the market, that the cash characteristics of the business are really attractive. So not only is it growing quickly, but it's growing in a capital light way, and it's generating a lot of cash as it grows.
Inspired Energy is a business that I've backed right back to 2011 when it IPO'd as a very small company. We made a new investment into strategic equity capital during last year into the company alongside some of our other funds. We're the largest investor in the company and been a long-term supporter. The business started life as a specialist consultancy focusing on energy procurement, particularly into corporates that were high energy users, helping them to optimize their bills through data and analytics. And over the life of our investment, it's evolved partly through consolidation. So it's been an acquisitive business that's bought up other energy procurement consultancies. And in more recent years, it's branched out into the area of energy optimization, which means it's helping its corporate clients not just to save money on their bill, but also to actually reduce their energy consumption. So in the current environment where sustainability and ESG are right at the forefront of customers, of suppliers and investors' attention, they really do have very strong credentials.